This is Mark Carrington from GoForForexProfits.com. In this video, I'm going to walk through the steps I go through to identify opportunities for which to trade options. So the steps are set out in front of you. I'm going to talk about how I screen candidates. I'm going to use as an example stocks that have a price to book value less than 1, so the market thinks they are not as valuable as their book assets. I'm going to check the charts. I'm looking for breakouts. I'm going to check the options chains to see how far ahead in time I can find options. I will check the premium that I have to pay from those chains relative to the chart to see if I can get asymmetric or disproportionate returns, and I will check implied volatility. So let's step first of all to my stock screening system. I use finviz.com to do the screening for US-based stocks. I have selected from my screeners here a price to book under 1. This is a free service and you can save your screens once you've joined up as a member. I'm just going to step quickly through the elements that are in this screen. There are only 7 items, as you can see here, 7 items. I'm looking for stocks over a certain size, small, medium, large, so I basically left out the micro stocks. I'm looking for stocks only. There are options to look for exchange traded funds, which makes it interesting, and I'm looking for stocks on which I can buy options, so they must be optional. Fundamental is the valuation criteria of a price to book under 1, and the technical criteria is basically how the charts look. I'm looking for something that's made a 20-day high, but I'm also looking for a staircase of moving averages so that the 200-day moving average is lower than the 50, which is lower than 20. So I'm looking for stocks that have already turned over. So the screen at the moment is showing that there are 30 items that are in the screen, and I can reduce the number. If 30 is too many to look for, the easiest way to reduce the number is to just go and change to small, mid to large. I'm going to leave small here for a particular reason, because there's one of the stocks that I already have options on and I want to talk about it. The next step I'll go through is I just want to have a quick confirm of charts. So the tool allows you to have to just list all the charts, and you can see basically where these breakout situations are. So here's a nice sideways breakout. This one's a sort of a crabbing upwards breakout. They don't all look like that. This one is just steaming ahead. This one has been going sideways for a while, but it has broken out over quite a few days. Here's one that's tracked sideways and now it's just broken out. That's Bank America. Barclays in the UK. We've seen the Brexit thing. We've seen it crabbing upwards and then consolidate and breaking out. The one I'm particularly interested in, which I have positions in already, is Leucadia, L-U-K. So I'm going to use that as my example to work through what I do. So remember what I said. The next thing I want to do is I want to have a look at option chains. Now for options change, I use finance.yahoo.com, but one can get this information from Google Finance or from Bloomberg or from many places, or directly from your broker. So here's the summary of Leucadia. Things that are important here is price. Current price is 24.25, and you can see this is a 2-year chart. It's gone down, tracked sideways, and then has broken up, tracked sideways again, and just broken up again in the last couple of days. But what I'm really interested in is the options chain. I want to see how far ahead I can buy options. So I'll just click here, options, and it lists the chains that are available here. It's got February, March, June, September. I'll ignore these March 2026 because those are probably warrants, not options. So September 15, 2017 is available, so I can buy options. Basically, what is that? That's 8 months away. I prefer buy further out in time, but we'll use this as an example. Remember, the strike price was 24.25, so I'll look for an option and one strike out of the money, so I can buy at 25. I quite like that because the current price is reasonably close to that strike, and for which I will have to pay $1.45. So let's remember those 3 numbers. We've got 24.25 a strike of 25 and an option premium of $1.45. Open interest is a bit low here though, so I suspect when should I choose to buy this, I will be the first person who has bought that. So we'll find that we'll land up in June 16. I just want to see what open interest looks like for June 16. Open interest at a 25 strike. There is no open interest there, but there is open interest further out. So there is some liquidity in this market. Anyway, so let's step across to the charts. The chart here, I use tradingview.com as a charting platform. It gives me good delayed data for stock markets right across the world. And we've got Lucadia here. LUK is its code, and this is a daily chart, 1D, so each bar is a day. And you will see here there are already some lines drawn on this chart. This is how I bought my last contract. Price had been tracking downwards. You'll see here it had been tracking downwards, had broken out, and was tested, broke through this horizontal level, and I bought the stock here at the start of this. I bought the option here on the 26th of July after it had broken out, after this little hiccup here in the price here, which I suspect was to do with earnings. And as it happened, I bought so price was here, 26th of July was below the 26th of July. Closing price there is 18.12. So if you see where the little thumb is pointing, the hand is pointing directly above, you'll see the C 18.12 at the top of that dotted line. So I could have bought the stock at 18.12. Instead, I bought one strike out of the money at 19, for which I paid $1.22, and the price is now at 24.25. So we've actually done really handsomely. But that's the history. Let's talk about the future. I'm going to make a few adjustments to this chart. I've already done some work on the chart here to make this video short enough, and the work I've done here is basically, so remember, there's the current price, 24.25. that's the current bar. Close price 24.25 up there. This ray here is the 25 strike option that I can buy with the expiry in September 15th, which is the end of the ray. So that's the break even. The gap between those two is the premium of 145. Let's just write that in, 1.45 premium, so we remember what it is. I'll stick that in there. That's the size of the gap between each one, and you'll see that is the same for each. So that is break even. This first one here, that's 100% profit. That's 200% profit. The question is can we get to 200% profit by expiry date? Now, how do I do that analysis? Is I have a look at patterns in the chart. So for example, here's one directly in front of me. We had this long period of consolidation here. This is about 2 months here, and we're in the process of doing one that looks a little bit similar. And so the first thing I can do is just say, well, what happens if we get that price movement repeating from where we are now? So I'll just draw in an arrow in, so it's got the same steepness, it's got the same steepness starting from the same low point, and we'll see if it did what it did from November last year, which is directly after the election, it will comfortably reach that 200% before the expiry date. In fact, it'll reach it before the end of February, so one would be very comfortable pursuing that. But it may not do that, because if for example, if price chooses to move, let's just find something else that might look a bit similar. So I'm going to get rid of these two arrows so that we don't prejudge the way we're thinking about things. Let's just go back in time, and here is another one. Here's another situation. Is it comparable? I don't know if it's comparable. We've certainly got a consolidation period here, a bit of a pullback, and we could sit there and say, well, maybe this will be a comparable one. And already, you can see directly that the size of that and the steepness of that would very comfortably take us past there. But this one might we be working from here. We would have no trouble if it was to do that. The important part of this particular run up here is it gives me an idea of where prices come from. So in the middle of 2013, price was already comfortably higher than the 200% marker. So that's an attractive trading opportunity for me. That's certainly why I was attracted to it here, and there is certainly scope for it to do the same again from here. So it is a candidate. What makes me uncomfortable about it is that if price takes a long time to make a move, so if we take for example, if this current move takes as long as the next move takes as long as this move took, I'm just going to draw the length of the move, copy that arrow, and go that from where we are in the current price, we are going to, if it takes as long as that move took to come down that far, so in these stock prices they often take longer to go up than they do coming down, we will see we actually start running out of time here if the move is that sort of length. And this is ultimately becomes the art of in options investing, is measuring how long it'll take to reach the target and have you got enough time, because in options trading you lose money when you run out of time. If we take this run up here from the 2010 run up as another example, I'll just draw this one here, I'll clone that one in. I've changed this chart to a weekly chart so I can see things more easily, and we're going to do that from the bottom there. I'll go back to the daily because we know that the chart is now the right length and the right steepness, and then we'll see what it does. And we'll do this from, if we do it from the bottom there, we're comfortably going to reach there. If we do it from this point here, we're comfortably going to reach the target. We're comfortably going to reach our 200%. So this is an interesting trade. Given that I already have a trade on it here, I may not choose to add a new position here, but I'm certainly going to be holding on to this position. The last thing I said I would do is just have a quick look at implied volatility. Now, implied volatility is the measure of the volatility of the share price over time, and it is used to calculate theoretical options prices, and it is very important. Now, to get hold of implied volatility data for the US market, I use cboe.com, which is the Chicago Board of Exchange, and they have a series of trading tools. The volatility calculator is one of them. I'm basically going to type in the Leucadia stock code in here, hit go, and it will calculate the implied volatility for me. It's taking its time to do that. It has now done it there. I can see Leucadia National Corp. So it's giving me data on historical volatility and implied volatility. One can try to read the table, but I'm just much more skilled at reading charts. And here is the implied volatility chart. And now the important part to note here is you can get charts for 3-month volatility, 6 months volatility, 1 year volatility. Because we're looking at options contracts for September of this year, which is between 6 months and a year, I've actually pressed 6 months, and the important chart is part of the chart is the orange line here, and we can see that the implied volatility has actually been reducing steadily over the last 12 months. This is a year's worth of data, and it's around 25%. So that suggests to me that the options prices are okay. It's not going to get any cheaper than this. So that is the summary I just pull up what we've done is we've screened the candidates on a price to book value of less than 1. We've checked the charts. Is it a breakout? We've checked the option chains, found the premium, gone far enough ahead in time, and then we've looked at the premium relative to the chart and said, have we got enough time, and are we overpaying for the option? And there we have a view on the possibilities for Leucadia as to whether we think we can get a 200% return. And one could argue here that 200% is looking good and 300% is even possible. From my own point of view, I'm a little bit uncomfortable because if it tracks slightly like this, is we're going to run out of time and we may have to roll forward to get more time. I would far rather be invested in one of the other companies on this list, so I'll just pick one. Bank America. Bank America I have here. I can buy January 18, 2019 options. Current share price is 23.44. I can buy them for 25, for which I'd have to pay 3, so I'd need to be breaking over $28 to break even. Do I think Bank America is going to do more than that? And then the process then would be to have a look at the charts and to decide whether a Bank America is going to do better than that. And I do have a chart of Bank America here somewhere. I'll just type it in here because this is work I've already done. Bank America, there it is. There's the current price. There's some contracts that are in place. That's the current price. That's the 25 strike. And what I liked about this is that the expiry is where this dotted line is. So if it follows this pattern which I've borrowed from somewhere else, it's not going to make 100% coming from this bottom, but if it comes from this consolidation period here, this line was borrowed from over here where we had a period of consolidation and then the run-up. If this consolidation period runs along here, is that we will reach the 200% level before expiry. We won't reach 200%, but we'll certainly reach 100. We'll get to 150, maybe 175 before expiry, because we're so there's a risk factor. I appreciate your time. Thanks.